Today, folks, one of the funniest things I heard is that us that live outside of the United States are watching the US right now the same way people that lived in the US were watching Tiger King, and I'm just kind of floored that the only drama that we have here in Canada is that Mark Carney has exposure to like 574 individual stocks, which is kind of just blowing my mind. I don't know if they're just pulling this out of some like mutual fund or how he owns this many individual stocks, but this seems more like typical political drama over the whole, crazy Epstein PDF file stuff going on there in the US. But regardless, I'm just looking at my stocks, guys. I'm just trying to live my life here, and at least Elon's playing along. Even a long time ago in a galaxy far, far away, the most evil person in the universe was a career politician. And this is why I don't care about politics for my financial independence. I'm just working here in my community with my family, trying to make the best that I can out of this while we watch this with a bag of popcorn. But sitting in the midst of earnings season, we're going to finish the week relatively flat here by the looks of it, folks. And I just want to talk about, again, this concept of FOMO, and I'm feeling it. I'm doing one-on-ones with people. I'm talking to people in comments and groups, and I'm seeing a lot of this chasing going on that does come quite concerning to me, because again, if you're going to catch these stocks after they do these 300, 500, 700% run-ups, every clown can sit there and just be like, oh, you got to look at the valuation in the long run. Like this has so much potential in the future. But again, if you're going to pull ahead 10 or 20 years of value, you could be in a dot-com situation, which there's a ton of stocks right now. In hindsight, will be those stocks today that people are buying. Obviously, nobody really knows what the future holds, but Netflix, I think, is becoming a prime example of valuation concerns. This is not a cheap stock by any metric, and it has been proving a new growth phase, but we find growth comes in ebb and flow patterns. You can't have a perfect straight up into the right business. There tends to be slumps, economic effects that can change the outcomes of earnings. But Netflix has been in this period where they've been able to raise prices. They've been seeing a good onslaught of growth again from some shows they've been producing. But nonetheless, they're still predicting like incredible growth numbers. There's nothing short of impressive here. When you look at what's been going on with the diluted earning growth, you look at the year-over-year revenue growth here, 15% expected to be 17% in Q3. Like, these numbers are nothing short of astonishing, but again, it's not the growth numbers we had before. And if we take a look, because right now, again, we're trading at the 15% range, the mid-teens, whereas before they were in the 20 to 30% range. But again, when you go look at the price ratios of these companies, and what I keep stating is we're going back into price multiple expansions. This is not a market that I'm particularly fond of, because again, in the 50 or 60 range, the last time we kind of saw that out of Netflix was really during that period of 30 to 50% growth periods. So I wanted to just digest that a little bit, that if this market does slow down, and even at the earnings we have, we could start seeing stalling out. That is a very real likelihood. I've told you guys, in the short term, nobody cares about valuations, but eventually those chickens will come to roost. That's just a matter of time, realistically, right? This is why I see people like Martin Shkreli shorting quantum stocks, because they know those chickens will inevitably come to roost. And this is what I've been saying too about the Canadian markets. The Canadian markets are no exception to this rule. And I've been blown away by the multiple expansion that's been happening here. We're trading at levels not seen since the earlier 2000s. Could be another sign that we are in some peculiar, again, when it comes to first and foremost AI, which is hard to tell if it is a bubble or not, because we don't know the value that it's going to add in the future. We know it's going to be an expansive period of margin. We're seeing it now with companies laying people off after lying to us. Oh, AI, it's going to help with your job. It's gonna double your output, but that it's not going to hinder employment. Meanwhile, like Microsoft just laid off like half their video game division. Like, it's just crazy, right? And they're retraining their entire staff on AI. I'm not sure how any of this translates to the Canadian economy, considering we've had the bullish run up now in the commodity sector, and a lot of our sectors are trading at wicked high multiples. Again, we're trading at like the average Canadian market here is at 21 times. Again, not seen since more or less the .com area. But I've said this with Royal Bank is an easy example, because Royal Bank to me is just, it's this boring traditional company, has very modest growth rates. It'll never go into tech-like growth phase, right? So if we go on to macro trends here, let me just put in Royal Bank, get this correctly here, because this is what I like pulling up, is just taking a look, because it's trading at levels. We go on to those price ratios real quick, at levels never before seen in the company's history, really going back to even 2010, it's kind of extreme, right? Considering we're still only talking about 14 times. And again, we haven't seen growth or earnings like excel past where they were in 2022 when the company was trading at 10 times. So that means there could be 40-50% overvaluations right now in some of these Canadian markets. What does this mean for my portfolio as a whole? Well, I'm still very happy with how I'm leveled out. I feel like I've de-risked my portfolio for my understanding of Google, like buying things that have lower valuations. Again, you could say that the S&P is expensive, but I've looked at earnings and I'm saying the earnings are fairly decent. I don't mind paying a 20 times multiple for an ETF if the earnings are at the 15 to 20 percentile range, right? And we're seeing a lot of great recovery in some of the more traditional, boring dividend stocks, whereas tech stocks might take a bit of a breath while the lower half of the market starts to catch back up. There always is ebb and flow in that sense. But again, tech, I think, is always going to be the gem and the defining factor to any future multiple expansion. So again, this is why I'm always I'm happy that I've had my exposure to Canada. I keep it 15 to 20%, and it's done very well. It's outpaced the US markets. I don't know if that's something that can continue in the future, but that's why I look at, leveraging into some of these individual stocks in hopes that they can even cushion any blow there might be. And I love looking at Google. We'll talk about that in a moment. But yeah, I mean, the markets, this week have done very well. Year to date, again, we're all in line across the board. We haven't seen the full rate of return, the historical 10 to 14% we usually see from some of these indexes. But again, those earnings are going to be the defining factor to all of this. And again, some of those earnings values are starting to come into question. But we are seeing a rotation into my favorite, Google, there finally being a one of the leaders next to NVIDIA this week, and still arguably very favorably valued. And I'm crossing my fingers that earnings will help justify us to that $200 range, and then I can start taking profit. I'm hoping in the $225 to $250 range. That's kind of my plan with Google. And my average buy on it right now is around 174, I believe, for my accounts. So yeah, I'm hoping that I'm going to pat myself on the back greatly for leveraging into this the way I have. Time will tell. Across the board, though, again, not overly exciting for Meta. Another large position between our accounts, the wife and I. But otherwise, yeah, it's been a pretty boring market with the exception of some random things in here. And same with the Canadian markets as well. Canadian markets have been splitting off from the non-energy minerals after the massive run up in precious metals. I'm still thinking there's a good run to be had there because I don't think we've seen this stint of growth. Gold's holding surprisingly strong. We've seen another nice bump up in silver, continuing to head higher, which is, I'm sure, very bullish for a lot of these precious metal explorers. Copper's another one here that's hitting new all-time highs. So I don't think in this sense that the Canadian market might have had its day just yet, and maybe the metals could be the defining factor to justifying earning multiples, but it ain't going to be in the oil sector by any means, and the financial sector has a lot of catching up to do to start justifying the higher premiums that we're seeing in some of these mega tech or mega financial companies, right? And again, even with the tech companies, Shopify, I'm a little hesitant on here as well. Shop's trading at way too high values. Yet again, I think to justify where it's at, I always consider Canadian tech companies to be bubbles because they go through these crazy valuation expansions and they never recover like they do in the United States. I mean, think of it. We're nowhere near all-time highs after the bubble bursted for Shopify. Again, we just have two tech companies and far too many dollars chasing them in this country. But a lot of people are, recognizing, and I'm congratulating anybody that did dive into the controversial Brookfield or BAM. Brookfield Corp that the Mark Carney has been criticized for being an owner and somebody that has worked on the board of because man, it has really popped off in the last week here, and yeah, starting to offer pretty good gains. I know a lot of you recommended Brookfield to me, whether you're buying it as BN or BAM. Like both these tickers are doing exceptionally well, pretty much similar companies, but yeah, really awesome to see these starting to take off on the back of perhaps some government corruption here in Canada, and I'm glad this is the pinnacle of Canadian corruption conversations. But nonetheless, folks, when it comes to my individual stocks, as mentioned, Google trade, we'll see if we can get to the 220 range anytime soon. I think we've got a lot of room to run here to 21 times PE. Meta is going to be probably flatlining depending on how earnings go, because again, I think we've run up into favorable values, more fair values for Meta. I'm happy holding it here nonetheless. We'll see what earnings kind of define for us. And when it comes to Take Two, I know a lot of you have been pointing out that I should still be in this ticker. It is starting to retrace. It's almost down 5% from where I sold out of it. Again, I'm not excited to see the stock go down by any means. It's could be a buying opportunity for those out there that are waiting for the GTA 6 hype, but I think we're heading into a flatlining phase where that hype has to come at some point. We're seeing that hype kind of populate other stocks like Labubu's. I know Labubu's, right? Like, if you know what those are, go check out the company. You can Google it. Go check out the company that is literally, funding that hype train right now, because they're crushing it. And I think that's the kind of hype that I'm expecting out of Take Two Interactive. So you just got to be a bit patient here for those holding. But again, to me, this might be an off trade where I might try and trade the momentum, because I think it's going to last for more than like a day or a week. So if we get closer to GTA 6, people start hyping this back up, I might get back into it for a shorter term trade. But for now, I'm happier, not having the over leveraged risk, because I mentioned to you guys this week, over almost a quarter of our portfolio was in individual stocks, and even still we're sitting, I think just around the 20+% range, and I really want to keep pulling that back. I want to get closer to 10 to 15% between our combined accounts, and today I'm a little more leveraged than that, but I'm okay with it because they are in shorter term trades. I'm not going to be in Google at this level for a long period of time, and if we don't get there or we correct, I'll still scale it down a little bit, try and get these positions closer to 5%. So Meta, Google, between both our accounts are at 5%, and then maybe some of these other positions like a Duro, small caps, some of the other crypto stuff that we hold. I just don't want to be, again, getting to the giddy point when the market is overly giddy and overly fear of missing out. Because again, in long periods of time, when those correction comes, and they usually do, those that over leveraged in the top are, last in, first out. And I don't want to time any of this, so I just really want to keep focusing on the index funds, get a nice base here, and we'll see how it pans out. But I'd love to know what your portfolio is made of, and what your plans are in the near term in this fascinating market environment.